Hello and welcome to our 10-minute property tip on cash reserve requirements for your property investment portfolio. Today we'll explore how cash reserves can make the difference between a thriving property portfolio and one that's vulnerable to unexpected shocks. Whether you own a single rental unit or a large portfolio, understanding how to build and manage cash reserves is critical to your long-term success. So let's dive in. What is a cash reserve? Let's start with the basics. A cash reserve is money you keep aside specifically for emergencies or unforeseen events in your property business. Think of it as your financial safety net. These are funds you don't use for daily operations or for your personal expenses. They exist solely to protect your investments from risk. Now, why would you need such a safety net? Let's look at the types of events that make cash reserves essential. Firstly, unexpected property expenses. These are costs that can strike without warning. Examples include a burst geyser flooding your rental unit and damaging flooring or walls, a plumbing leak causing water damage to multiple units, pest infestations that require professional treatment, electrical faults that create safety hazards, and sudden damage to boundary walls or security gates. These problems often arise due to the age of a building, normal wear and tear, environmental factors like storms, or even accidental damage by tenants. If you don't have cash on hand to resolve these quickly, the situation can spiral. Small issues left unfixed can become big problems, leading to even higher costs and potential legal liabilities. Next, let's talk about vacancies. Every property investor will encounter periods where a unit stands empty. This can happen because a tenant moves out unexpectedly, economic downturns reduce the pool of tenants who can afford your rent, seasonal demand fluctuates, especially in areas like student housing. You're conducting renovations that temporarily make the property uninhabitable. Vacancies mean your rental income stops, but your expenses don't. However, you still have to pay bond repayments, rates and taxes, levies, insurance, security and basic maintenance. Without reserves, you'd be forced either to cover those costs from your personal funds or worse, to sell the property quickly, often at a discount. Another reason for cash reserves is emergency repairs. These are urgent issues that simply can't wait. For instance, a roof collapses after a storm, a major sewerage blockage causes flooding, or the main security gate breaks, leaving the building unsecured. These events can arise suddenly, even in well-maintained properties. If you don't address them immediately, tenants may be forced to move out, your property could become non-compliant with housing regulations, or you might face legal claims for unsafe living conditions. Emergency repairs are usually large, once-off costs, and not something you can cover from monthly rental income. A less visible, but equally significant risk is a market downturn. A market downturn is a period where property values decline, rents decrease, or demand for rental properties drops. These can be triggered by economic recessions, interest rate hikes, which reduce affordability, or oversupply of rental properties in your area. During a downturn, property values may fall below your purchase price, tenants might default on rent or demand rent reductions, and selling properties becomes harder, forcing you to hold on longer than planned. Having cash reserves allows you to survive these periods without panicking or selling at a loss. So how exactly does a cash reserve protect you? A reserve acts as a buffer between you and financial distress. It buys you time. Instead of making rush decisions, like slashing your rental price, borrowing at high interest, or selling a property at a discount, you can use your reserve to keep your mortgage repayments up to date, essential repairs and services flowing, tenants happy, and your reputation intact. A financial buffer allows you to manage your properties from a place of strength, not desperation. Now let's talk about where you should keep these funds. Cash reserves need to be safe, easily accessible, and earning at least some return. Here are some common options. Savings accounts. A regular bank savings account is the simplest place for your reserve. Advantages are immediate access, safe and protected by deposit insurance, and easy to manage. Disadvantage: very low interest rates, often below inflation. Money market accounts are a step up. They invest in short-term government or corporate debt, offering better interest than a basic savings account, reasonable safety, and good liquidity, though some require notice periods for withdrawals. These are ideal for medium-term reserves you don't expect to use immediately. Low-risk instruments include short-term fixed deposits and treasury bills. These offer higher interest rates than savings or money markets, however, they're not instantly accessible. You may need to give notice or wait for maturity dates. They're best used for parts of your reserve that aren't intended for immediate emergencies, like your CAPEX fund. Some investors choose to keep reserves in an offset mortgage account. Here's how it works. Your cash reserve sits in a linked account. It offsets your mortgage balance, reducing the interest you pay on your loan. You can withdraw the money if you need it. This is a smart way to make your cash reserve work harder without risk. Let's dig deeper into why cash reserves are so important for property investors. It protects cash flow during unexpected events. Real estate is all about cash flow. If your rental income stops due to vacancies, or if costs spike due to emergencies, your cash flow suffers. A reserve ensures you can pay your bond, handle repairs, and maintain services. Without it, even one unexpected event can disrupt your entire business. It helps to avoid forced sales. Running out of cash might force you to sell property quickly. Quick sales usually mean lower sale prices, higher transaction costs, and potential capital gains tax liabilities. Cash reserves buy you time so you can sell when market conditions improve. It maintains loan repayments. Banks expect their repayments every month. Late payments damage your credit score, and repeated defaults can lead to foreclosure. A cash reserve keeps your bond payments safe during tough times. It preserves creditworthiness. Your credit score determines whether you can qualify for new loans and what interest rates you pay. Missed payments due to poor cash flow damage your credit score. A healthy reserve protects your credit rating and your ability to grow your portfolio. It provides peace of mind. Cash reserves reduces stress. Property investing already comes with plenty of challenges. Knowing you have a financial cushion means you can focus on strategic growth and you're not kept awake at night worrying about the next emergency. Not all cash reserves serve the same purpose. Let's discuss the four main types. Operating reserve. This covers routine operating costs, short-term fluctuations in expenses, minor repairs and maintenance, and temporary drops in income. It keeps the property running smoothly even when cash flow is inconsistent. Capital expenditure, CAPEX, reserve. CAPEX reserves cover major, infrequent costs, such as replacing a roof, installing new plumbing or electrical systems, refurbishing elevators, or repainting entire building exteriors. These expenses are often significant and can't be covered from monthly rental income. Debt service reserve. This reserve ensures you can continue paying your bond repayments even if you experience vacancies, tenants default, or cash flow drops unexpectedly. It's especially critical if you're highly leveraged. Opportunity reserve. An often overlooked type is the opportunity reserve. This is cash set aside to buy distressed properties at discounted prices, fund unexpected but profitable deals, or make fast moves in the market when bargains arise. Having an opportunity reserve gives you flexibility and a competitive edge. How much cash reserve do you need? There's no one-size-fits-all number. But let's look at common guidelines. A good rule of thumb is 3 to 6 months of all operating expenses for each property, including mortgage payments, rates and taxes, levies or body corporate fees, insurance premiums, and routine maintenance costs. This ensures you can survive several months without rental income. 5 to 10% of property value for CAPEX. For CAPEX, reserves aim for 5% to 10% of the property's value. Older properties often require higher reserves due to more frequent major repairs. 5 to 10% of gross annual rental income. Another rule is to keep 5% to 10% of your annual rental income as a general cash reserve. This covers legal costs, tenant churn expenses, bad debts, or unexpected fees. Factors influencing reserve size. Your specific cash reserve depends on age and condition of your property. Older properties equals higher reserves, property type. Commercial often needs more reserves than residential. Market volatility. High-risk areas need higher reserves. Size of your portfolio. Larger portfolios might allow shared reserves. Your personal risk tolerance. Conservative investors keep higher reserves for peace of mind. Let's run through an example. Imagine you own a residential unit with the following monthly costs. Bond repayment of 15,000 Rand, rates and taxes, 3,500 Rand, insurance, 1,000 Rand, maintenance allowance 1,500 Rand, which equates to a total monthly expense of 21,000 Rand. If you want 6 months of expenses in reserve, your calculation is 21,000 multiplied by 6 equals 126,000 Rand. For the CAPEX reserve, if the property value is 1.5 million rand, you might keep a CAPEX reserve of 5%, which is calculated as follows. 1.5 million multiplied by 5% equals 75,000 rand. Therefore, your total recommended reserve is 126,000 plus 75,000 equals 201,000 rand. This protects you from both income loss and major repairs. Now let's talk about how to build these reserves. Start small and be consistent. You don't have to set aside your entire reserve at once. Even 1,000 rand a month builds up over time. Consistency matters more than size. Prioritize reserve contributions. Treat your reserve like a monthly expense. Allocate money to it before paying yourself dividends and don't treat it as extra profit to spend. Keep funds liquid. Your reserves must be accessible quickly in an emergency and not tied up in illiquid assets like long-term shares or property syndications. Replenish after use. If you use your reserves, replenish them as soon as possible. Don't get caught short twice. Review regularly. Adjust your reserves when you acquire new properties, your expenses change significantly or market conditions shift. Where to keep cash reserves? To summarize, keep immediate emergency funds in savings accounts for quick access, place medium-term reserves in money market accounts for better returns, park longer-term reserves in low-risk fixed deposits or offset accounts to reduce costs and avoid high-risk or speculative investments with your reserve funds. Best practices and tips. Some final best practices. Always separate personal funds from reserve funds. Build reserves for each property individually. Never invest reserves in risky assets like crypto or speculative shares. Factor reserves into your ROI calculation so you're not overestimating your returns, and make sure partners or co-investors understand the importance of keeping reserves untouched. Risks of not maintaining reserves. If you skip building a reserve, you risk forced sales of property at poor prices, missed bond payments leading to foreclosure, a damaged credit record, making future borrowing difficult, emergency repairs spiraling into major crises, stress and sleepless nights. Benefits of adequate reserves. On the flip side, maintaining reserves means financial stability, time to wait out market downturns, confidence to negotiate deals, ability to handle emergencies calmly, better reputation with banks and partners, and ultimately peace of mind. So let's recap. Cash reserves are non-negotiable for serious property investors. They protect you from emergencies, vacancies, and market shocks. Build them consistently, review and adjust them regularly. They are your insurance policy for long-term success. Thank you for joining us for this session on cash reserves in property investing. We hope you now feel equipped to plan and maintain your own cash reserves so you can protect and grow your property portfolio confidently. Until next time, stay safe and keep investing wisely. Thank you for being part of the EDPF Academy, #1Million Title Deeds Project. We hope you will continue your journey to property ownership with us by registering for our Academy course at www.edpfacademy.app or visit our main site at www.edpf.co.za for more information about EDPF.